Good morning, folks, and welcome to the 51st edition of the weekly wrap. So we crossed the golden Rubicon last month with the 50 editions, which was received very well. Thank you. And here we are. Last time we spoke about a peace deal happening around the corner because we thought that both the countries were really up to the limit as far as their resources were concerned. And lo, that's what we have. So we have a peace treaty signed in France. And we really can't make out who's the winner, but the treaty was signed, period. So that's what all we are concerned about. And as a result, oil prices have already fallen. And a number of institutions are saying that $60 a barrel is not off the table, in their own words. But we estimate it would come down to 80 or so within this year. The reason being that it won't come down to pre-war levels immediately. A number of countries are going to be stockpiling oil. They've all drawn down on the strategic oil reserves to try and keep the price in containment, right? And when we see the graphs for countries like the US and China, their strategic oil reserves have drawn down heavily, and they need time to fill up. I guess we don't have the numbers for India, but I'm guessing India would have also drawn down on the reserve. And so we will be spending the next few months filling up, consuming and filling up. So it's a double demand. And we are not going to see logistics come back to normal very soon. So all this together, there will be some stress on prices. It will not collapse immediately. It will not fall down to pre-war. That's one thing. Number two, we have seen stock markets look better. We had the huge SpaceX IPO and prices stratospheric at $200 plus. So, but let's keep in mind a bit of history, right?
Yeah.
So whenever we saw these huge issues from Meta and the like in the past, we had a period where they listed well, and then a long period where the price had collapsed and they needed to prove themselves. Okay. So here we still have a negative margin on SpaceX, and God knows when it will take for them to prove themselves and come back to positive territory. So that's a journey I guess the investor is willing to take when you've gone for the IPO. The good part is the gold imports have fallen after duty went up. So to that extent, there's a lesser stress on outflows, and FCNR deposits, I guess, would be coming in. Remittances from NRIs are again coming back. So I think all these go to strengthen the rupee in the medium term. And that's already showing where we've recovered and we are at 94 odd. And I think some estimates are saying that we should go anywhere up to 92 before we start our long-term trajectory of depreciation again. Okay, and I guess stock market should also be feeling better for all this. FIIs, I guess, will start coming in sometime or later. Let's not break our heads on that. The next thing, since the war part is over, media is going to hype the next worry. Okay, and the next worry that they are going to hype is monsoons. And well, we've gone through bad monsoons in the past. We may have gone through another bad monsoon now, but let's remember that our food production is pretty good. Our food reserves are pretty good. Okay, so it may not hit inflation as much as one thinks it will. Okay, so let's not get too pessimistic. Keep the long term in mind and don't stop your investment journey. Correct?
I would completely agree with that 100%.
Yes. So there we have my colleague Nikhil speaking.
Hello everyone.
And we have a new face for you, and I promise you it will be an interesting journey. Okay. So Nikhil, this time I would like to just focus on two issues. Okay. And the first one is an interesting, always controversial headline. Why investing in Indian real estate can't make you rich. This is what our friend Rishabh Desai writes, and I tend to agree with whatever he has written in this article. Okay, it's about the great Indian emotion towards owning real estate. Okay, and it's only now since Demon that we have seen even the wealthier families diversify their assets into non-real estate and move into financial assets. We are seeing the evidence of all of that in the number of demat accounts and the way the stock markets have moved better since then. But let's spend a minute on what are the expected or what are the returns that happen out of real estate, Nikhil?
Yeah. So in terms of the expected returns for real estate roughly grows, at least residential real estate grows at roughly around 5%, versus the equity market, which grows at about 14%. Okay, and to put it into numbers as to what this would kind of look like, okay, a real estate investment over 10 years would grow your money by about 1.5 times, versus equity, which could grow it at close to 3.5 times. Okay,
That's a huge difference in the multiplier.
definitely, and it gets even more interesting over a 15-year period, wherein over a 15-year period, assuming all things constant, the equity portfolio could grow at about 7 times, versus the real estate index, which only grows at about 2 times.
Yeah. So to be sure, when we are speaking about the real estate index, this refers to residential real estate, which is the bulk of it is apartments.
Yeah.
And we've never ever believed that apartments are a good investment. It's fine as a roof above the head.
Yeah. Yeah.
And as Nikhil likes to say, it's good for growing plants, not growing your money.
Yeah, I think that's why my generation's comfortable probably not owning a home. But like, it's a bad investment, probably.
Yeah, but one needs a roof above the head.
Yeah, we do.
To that extent.
Yeah.
Otherwise, they're not a great investment.
Yeah.
But there are, I mean, you can buy property sites which grow at a higher rate in general than apartments. But even then, I think there's a fallacy, a mental fallacy, when we say, oh, my property's gone 2x. I bought it for 1 crore, now it's 2 crores. I bought for 1 crore, now it's 3 crores. Over a decade or so. But actually, even equity, which has compounded at around 14% per annum, has become 4 times, and over 15 years, as Nikhil says, 7 times. So 1 crore can be 7 crores in a simple large cap Nifty index, not counting mid, small, and all those complexities which can come in, but can grow your wealth more. So the fallacy here is that we look at the absolute number, and either we lack the arithmetical intuition to break it down into a simple per annum rate, or we don't even attempt to do so.
Yeah.
Correct?
Yeah.
So if you bring it down to a per annum rate, equity beats.
Yeah. Yeah.
Most often equity beats it hands down.
Definitely.
And that is what people don't realize. And the other thing is, people end up getting a 5x, 7x on their property because they've held on to it.
Precisely.
Right?
Precisely. I think at the end of the day, real estate investing should be viewed as, at least residential real estate investing, should be viewed more as cocktail chatter than something that has serious legs to stand on.
Yeah. And equity, only because it is liquid, people don't end up holding it for 5-year, 10-year, 15-year periods. And if they held on, they would see much greater returns.
Definitely.
So it is liquidity, ease of trading that makes them not hold on to equity, and the illiquidity of real estate, which makes them hold on to real estate and see larger gains. So if one goes past this mental fallacy, equity would be the greater wealth builder, in my view. Right?
Yeah, I would agree with that.
Yeah. And then we have a very, very interesting article. It's a nice article, and again here in the ET Wealth by one of my favorite authors, that is Srikanth, and she writes on how you manage your finances after retirement. Okay? So why should we spend so much time on retirement? Okay. It is the largest period of your life where you are not earning anything else, but you're living off your savings and you have time on your hands. Which is why retirement is so important. We need to focus on this. This is going to be 40 years of your life.
Yeah. That could be like 1/3 to 1/4.
Yeah, more than a third, right?
Yeah.
More than a third of your life. So I always like to say, 1/3 of your life you are negative cash flow because you are taking from your parents and doing your life. 1/3 of your life is positive cash flow, where you are earning, you're growing professionally and earning income.
Definitely.
And then the balance 1/3 of your life, you're going back to negative cash flow.
Yeah.
And instead of parents, it's your accumulated savings that you need to be working on, is it not?
Yeah.
So Srikanth, right in the beginning, says, by the way, the headline here is "Simplify Finances After Retirement." Simplify is her mantra, and I completely, wholeheartedly agree with her. Okay, and she says here, your wealth must last you a lifetime and work for you as if you would live to 100 years. That is not an exaggeration. Whenever we speak with our clients, we are doing a retirement plan and we say, let's have a life expectancy of 95. We meet some incredulous stares and comments, right? Hey, no. They say, I don't want to live to 95, but that's not your choice.
Yeah.
You may end up living to a 95. You don't want to run out of money.
Yeah.
When you're 95, and the next gen will see 100.
Yeah. The way healthcare is improving, it is natural that we will live longer lives. So it is pertinent that we, plan for this sort of longevity, even though we might not see it.
Yeah, it's a probability, and nobody is dead sure that dead sure is a wrong term to use, but nobody is sure that we're going to go up to 95 or 100. We are willing to live with probability there. Okay, I will probably live up to 85. I'll probably live up to 95. There we are willing to work with probability. But when it comes to investments, why are we not willing to live with probability?
That's a really good question, sir.
Okay, so I think in our investment life too, we need to work with probabilities and say, what is the probability of my corpus living through my life expectancy?
I wholeheartedly agree.
And I'm sure if I ask this question, nobody will say I'm 100% confident.
Yeah.
Then work that probability into your lifestyle. If markets are bad, be willing to spend less.
Yes.
If markets are good, save for the future or spend more, your choice.
Yeah.
But I think we have to get a probabilistic mindset into the way we do it. We work it into our calculations in any case, by the way.
Yeah.
Okay. So Nikhil, let's get into this checklist with Uma Srikanth has given us 8 golden points. Let's start.
She's given a lot of interesting points. The first point that she mentions is to create a record of your assets. Everything that you own, be it land, stocks, bank, crypto, a cool haiku sort, keep it all on a piece of paper and make sure your kids can easily find the said record.
Yes, and I would think that apart from physical assets, you should also add your digital assets.
Definitely.
What is my laptop password?
Yeah.
What is my Gmail or email password? What is my LinkedIn password? What is my Facebook password?
Instagram,
Insta password,
Snapchat.
So I think even digital assets should be put down for your next in line to take care of, or tell the world that I don't exist or whatever. Right?
Yeah, I agree.
But that is something very important, and it is each of our responsibilities that we do not leave behind chaos. So be organized in your record keeping so that you do not leave behind chaos. So the second point that Uma makes is complete the paperwork that enables accessing and transmitting the assets after your time. Okay, so do you have the right nominations? Do we have the right joint holders? Do we have alternate signatories? Do we has your will been registered to enable easier transmission of property, landed assets? Okay, so let's remember that most government offices, the sub-registrars ask for a registered will for change of khata. So that is something one should look at. Your banks, your fixed deposit, your safe deposit lockers, your mutual funds, your deposits, your properties, all should have the right, clean, hygienic records. Ensure taxes are paid. And as per today's law, have you got an e-khata for your property? Because for a transfer, an e-khata is a must.
Definitely.
Okay. So that's the kind of point.
And I just add something else to that is to do periodic hygiene checks on these things to ensure that everything is in place. Otherwise, if you miss out on updating your nominees per se, it could get a little difficult transferring those assets, and though that's a cumbersome burden that you don't want to, that you wouldn't want your next of kin to inherit.
Yes, rightly said. If you have a good financial planner or financial advisor by your side, this will be part of their work that they do every year, a hygiene check. And if your planner is not asking for it or not doing it, maybe you should look for somebody who's doing it, or ask your planner to do it. Make it part of the process, okay, like we do.
Yeah. I think the next point that she brings up that I definitely found a little bit interesting was she says to evaluate the assets that you need versus what you don't.
Okay.
The idea here is simple. Embrace some form of simplicity in your life. Get rid of assets that don't bring you any joy or happiness, and keep the things that matter the most.
Great. It's again going with the simplify mantra.
Yeah.
keep what is necessary, dispose of what you don't need. It's like clearing up your wardrobe every Diwali. You need to also clear up your investment portfolio. Don't have too many line items.
Yeah.
Have as much as is necessary.
Yeah. What is required to maintain your lifestyle, essentially.
Correct. Okay. And she goes on to, say in the same that if you to have too many properties, do you need as many properties? Do your children need as many properties?
Yeah.
Do they have the time to manage them?
Yeah.
And this becomes a pertinent point more so when children are not in India, they're living abroad. And I've seen in so many cases they do not have the time to come to India and administer the properties, even transfer the properties to their names. So do think if it's required, otherwise liquidate it, have financial assets which can be easily transferred to any part of the world.
Definitely so.
Correct?
Definitely so.
Yeah. So the fourth one is similar. This is you may not need a long list of investments. Okay. So reduce your holdings.
Yeah.
Similar to what she has said about properties there. Here it's about financial assets. Keep diversified, but don't be over diversified. That's a mantra at any point of time.
Wholeheartedly.
Okay.
Yes.
So what the point here, I think, what am I saying? What you want to do in your post-retirement phase is simply beat inflation. You're not maximizing return.
Yes.
When you're beating inflation, maybe you can just do with an index fund, is what she says here.
Yeah.
Okay. That's something that one can consider if you're doing it yourself.
Definitely.
Yeah,
So. Definitely so. The next point that she brings up is to make a will of your assets. This is something that we at Hexagon promote. Because the idea is you want to ensure the smooth transfer of assets to the appropriate parties. There might be certain things that you'd want, maybe a certain child needs more help, or maybe there is a certain asset that you own that you would want maybe a friend of yours to own in order to remember the good times. It helps to keep an asset, a will in mind at least, to ensure that these assets are transferred appropriately.
Yeah. And like he mentions in the next point, it's good to be transparent.
Yeah.
Discuss your will with your children. Tell them what you're writing.
Yeah.
Is it not? Yeah. And especially if you have in your will people who are not your children or your spouse or blood relation, it's better to tell them upfront that I'm including somebody.
Yes. Yeah.
Heck, why should you be afraid? It's your property. You have the right to give it to whoever you like, as long as it is not your inherited property. If it is your self-made property, you have the full right to give it to whoever you wish. Okay. So do that. But remember, inherited property, your daughters and sons have equal right over it. Okay. So there you don't want to show favoritism.
Yes.
Okay.
The next point that she talks about is it relates around what sort of medical expenditures that you want to take, and essentially comes down to how you wish to die.
Yes.
It sounds morbid, but the point that she makes over here quite eloquently is that it's better you decide the terms of how you wish to leave this earth to the best of your ability, and not leave this burden upon your next of kin. And I think that is something that even I would also quite agree with.
It's a very sensitive point, but you have to deal with it. There's something called a living will. Okay. And in the living will, you can specify how you want to die. So you don't want to be intubated. You don't want to go on a ventilator. You don't want to be a vegetable in a coma endlessly, and your family spending a lot of money on you to keep your body alive. Okay. So then in your living will, you can specify what are the steps to be taken, what are the steps not to be taken. So if you say, do not resuscitate me in your living will, then there will not be an attempt to resuscitate you if you undergo an attack of any sort. And that's your choice. Okay. Don't leave it to your children to take that decision. Okay. Because if you're not of a strong mind, at some point of time the children may be plagued by guilt as to whether the decision was right or wrong. So don't do that. You take the decision for them. How do you want to go away? Mention that to your children. Even if you don't write it in the living will, mention to your children what efforts should be taken, what efforts should not be taken, how much money should be spent, how much money should not be spent, right? So I think that's a great one. And the eighth one is again very emotional in that sense. Okay. Review your non-financial holdings. Okay. they may or may not be valuable, but they run the risk of turning worthless once you are no more. Okay, there may be some books that you like, there may be some furniture that you like. I may have a collection of pens that I treasure, which nobody else may treasure. Correct? And don't accumulate junk. Is what she's saying. It may be
I think
useful for you, but if they are not useful for your children, if they are not having the same emotional connect with it, clean up.
I agree. Minimalism is probably the way to go. But I think to summarize all of it, though, I think a lot of this requires a lot of introspection and a lot of thought. If you do need any help of any sorts, a financial advisor would be a great way to at least get the ball rolling, so that you have some direction to head towards. That's how I would see it.
Yes. So that's all, folks, for this weekly wrap. Thank you for listening to us. Any feedback is welcome. Any questions are welcome, and we'll endeavor to answer them in the next episode. Have a good weekend.
Have a good weekend, guys. Thank you.